My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hello, boys and girls. Welcome back to another episode, Property Profits Real Estate Podcast. Today, zooming in from one of, if not my favorite city in Ontario, we've got Neil D'Souza, and Neil is zooming in from Kingston, Ontario. If you've never been, you definitely got to go. It's absolutely gorgeous. And Neil knows a thing or two about real estate. He's been in the game for over 20 years. These days, he focuses a lot on private lending, or what our friends in the US of A might call hard money lending. That's really what his specialty is. So Neil, welcome to the show. Great to have you.
Thank you. Thank you. Here in K-Town. K-Town in the house.
Well, hey, I live in Kamloops. We get to be K-Town too. Just a
there
smaller
you go.
version.
K-Town brothers. Love it. Love it. Yeah. Thank you for having me.
My pleasure. Neil, give us a little snapshot. What do you do around real estate these days? Just maybe explain it to us.
These days, well, most people know me for private lending. I've been teaching, coaching people, and helping facilitate and broker deals with private mortgages for better part of the last decade, and so that's what we do. There's a lot of people that are looking for alternative investments, especially in these uncertain times. And, one of the great things is you're able to teach people. It's really for me, I always share it like this. It is the best starter investment there is out there, because you can use RRSPs, the government allows you to do these things. And so as a result, it's a great place to start where you don't have to have that level of knowledge, and you actually have more knowledge about it than most people realize.
Okay, cool. So let's unwrap this for a minute, if you don't mind, Neil. So
yeah,
maybe define for folks who aren't quite sure, what does private lending actually mean? What does that look like? What kind of properties? What kind of amounts? Because, we're up here in Canada. Property prices are stupid. So just kind of give us an overview.
Okay, I'll give you the quick snapshot. This is it. Private mortgage. A mortgage is, we know what a mortgage is. You get that so you can buy a house. The only difference between a private mortgage and a traditional mortgage is the traditional mortgages actually come from an institution like the bank. A private individual makes it a private mortgage or a private company. And that's really the long and short of it right there. Now, the funny thing about that is that the private mortgage is actually the traditional mortgage for thousands of years.
Right.
Right. And because the banks are really only just over 100 years old. So, the private mortgages are the way that
used to be
has
done
happened.
And still is. Okay. So it's not something new.
The banks actually stole it from us.
Go figure.
Yeah.
So
but
Neil,
they did figure out a couple of things that allows them to make money and has helped us in the industry as well, right? So
and we'll dive into that for sure. So
Sure.
Neil, so we're up here in Canada.
Yeah,
I don't know about Kingston these days, but I'm pretty sure the average price of a house that people are getting into in Canada, we're in the $500,000 plus kind of range, especially if it's a detached single family home. So are your students and clients coming up with $500,000 to loan out on these kind of mortgages, or do you have to have super deep pockets to get into this, or what are your suggestions?
Yeah, that's a great question. So you don't have to. You can have. I've done personally, actually, with all my kids. I've actually brought my kids into this, and so my son may have.
You start making money from your kids instead of the other way around. That's smart, man.
My son did a loan for $3,000 because that's what he had, right? And so we can talk about that a little bit later, but the the reality is that when you're talking about private mortgages, to register a mortgage on the house costs money because of lawyers and that. And so you really, no one's tends to borrow less than, say, $50,000 in my experience, by and
Right.
large. So 50,000 and above. Now, sometimes, if you've got $25,000 and I've got $25,000, we can put that together
Yeah.
and we can do that. And that's what's called a syndicated mortgage. Two or more people, it's a syndication, and you can do that. So there is, you can do any sort of version of that. These days, most people that I deal with are going to have 100,000 or more. By and
Okay, so
large, we're
they're
in that
and
100
are
to
they
five hundred
typically
thousand
doing
range.
first mortgages or second mortgages or third mortgages? Are
That's
they
yeah,
helping
that's a great
flippers? What does this look like?
Yeah, great question. So you've got to see, this is where whatever your flavor is, right? I've got retirees that only do first mortgages.
Hmm.
They don't want to worry about what's going on in the market, up, down, sideways. But then I've got people that are experienced investors, and they want to invest in people that are doing flips, right?
They want to
And
turn their money more often.
that's right. Because,
Yeah.
someone that's flipping, maybe they're going to borrow the money for 4 months, 6 months, something like that. So you're looking to turn that over quickly. So that's a different type of investor, right? And then you've got people who understand, say, the debt consolidation space. And I teach people all of these spaces, but everyone sort of resonates with a different area based on where you are in life,
Hmm.
right? And it's kind of how I got into it, is because of where I was in life, having kids and that kind of stuff. I needed an investment vehicle that allowed me to do some hands off, right? I didn't have the time to be, while my kids are growing, to be out there and fixing the houses and that kind of
What is
stuff and
that?
flipping.
How you got it? Were you a fix and flipper beforehand?
That's how I started into
Yeah.
it, but then the private lending was, it actually showed up. I got my license to be a mortgage agent, and because I knew, hey, I want to do more in real estate, buy more income properties, just keep going along that road. And one of my mentors at the time, shout out to Shami Baba, he actually showed me this private mortgage thing. And then, of course, I started studying about it and doing that stuff. And lo and behold, people start asking, well, what are you doing? And so then you start teaching other people how to do that.
So Neil, do people need to become mortgage brokers in order to do this
No.
business?
No. So the aspect about being licensed allows me to talk publicly with other people about that. It allows people, other brokers, other agents to contact me with deals, and that's one of the things I'm able to facilitate, right? Because people have deals, and then they can come to me, and then I can pass them on to people in my group that are looking to facilitate those deals, as opposed to being an individual person trying to find deals. If you're not licensed, a, another licensed agent is not supposed to be discussing it with you unless you're an accredited investor. So that's the little piece, and that's sort of the bridge that I'm able to facilitate for the people around me.
Got it. No, that makes a lot of sense. So Neil, some of your people that are doing this, other private lenders, they start off with their own capital, but that might get tapped out sooner or later.
Yeah.
Do you see a lot of them kind of getting into it where they're starting to bring other people into the business,
Ah,
raise capital, that sort of thing? And if so,
yeah.
what does that kind of look like? You talked about a syndicated mortgage. What,
Yeah.
what are
Yeah.
they able
So
to do?
you're allowed to get into a lot of different areas here, right? And the type of person that borrows that money is also different, right? I mean,
Mm.
I'm the type of person that borrows that money as well, right? So for my own acquisitions, when I'm buying an apartment building, it's a whole lot easier to get private money, go in, acquire it, get a great deal, negotiate it, get a great deal, and then take it to the banks. And
Right.
then you already
And
own it at that
refinance it.
point,
Yeah.
and then refinance it, right? And it's kind of like the old Smith maneuver. You're able to get in there, get it, and then go along. Now, for people, when they're let's say you've got some money in RRSPs, you've used that, you had some money in cash, you've used that. Now what do you do? It really depends on the person where you're at. Some people will bring other family members together and they get in on it. There's a lot of people that family. It's like you're the one person in your family that has that investment mindset, so you're able to pair up with other like-minded people and go ahead and do that. And so
Hmm.
you can get into properties. One of my specialties is rural lending, and the
Okay.
people that lend with me, we like to lend outside of the GTA, which
Because the
is
banks hate that, right? The banks
that's
like cities.
right.
Yeah.
That's right. So a lot of people like the big cities. I tend to, and the people that work with me, we tend to like getting out of the city because there's tons of competition. Your returns are going to be lower, that kind of
Hmm.
stuff,
In the city.
because
Yeah.
of
So
that
when you
in the
get out of the
city, right? So
city,
once you get
less
out,
competition.
less competition, lower mortgage amounts. You can go to somewhere like Kirkland Lake, Ontario, and buy a house
Hmm.
for $100,000. So all of a sudden, a first mortgage could be $70,000. That's 70%,
Yeah.
right? Loan to value. So all of a sudden, there's opportunities for people who may not feel like they're big players to be big players throughout, and you may know something about a certain city, and so you may be comfortable. You may want to lend there because you're also buying there, right?
Right.
So
Right.
there's
Now,
there's a
what
lot of
what
different
kind of
advantages that way.
suggestions do you have for people that don't have a ton of experience doing underwriting? Because that would be a huge
Yeah,
part of this, is to make sure you cover your butt, that your
yeah,
hard-earned money is secured. What
yeah.
what are your thoughts around that?
Okay, I'm not going to be able to give you enough information
No, I
in
don't
this
expect you to
podcast
teach us how to do it,
to
but
really understand that, but I
yeah.
what I can say, some of the basics, and this is sort of how we would look at it for, say, our retirees. And a retiree, maybe they've got $400,000 saved. They
Yeah.
don't want to eat into their nest egg, and so they're living off of the returns, right?
Mm,
Or it's supplementing along with
yeah. Pensions and
CPP and
whatnot.
all the
Yeah.
rest, right? So someone like that, you're only doing something at say 50% loan to value, and how do you underwrite that? Well, because how do I know that that place is actually worth that price?
Yeah. That
They
that
say
it really
it's
is
200,000. How do I know?
yeah.
We have appraisals. You've got licensed appraisers, and and you can get that. You got an application. Do they have jobs? You just look for some of the common sense ways,
Mhm.
and one of the things I find in this is you can see yourself in the borrower,
Mm,
right?
yeah.
Kind of like if you own property, if you're a landlord. I always used to like to rent to people that I understood, people that had kids, because I had kids, and I knew what someone who had kids, what kind of things they thought about, right? And so it made it easy to, okay, yes, this person fits for what I'm looking for in this unit, and it's kind of like that in when you're
Yeah.
underwriting these
So
kind of deals.
you want to make sure that you're collateralized, that you've got collateral there,
Yes.
and that you
Yeah.
resonate with the
You got,
person that's borrowing the
yeah.
money
So
from you. Yeah.
collateral, character, and credit are really
Hmm.
the three main ones. You want to make sure that they've got decent credit. You understand their credit situation. You want to
Hmm.
make sure that you understand them as people. They've got jobs. How much debt do they have? That kind of stuff. And then collateral is always going to be the main key. And the less, the lower your loan to value is always going to be your safest bet.
So I got two questions as we're kind of wrapping this up here, Neil. The
Yeah.
first one is, so I lost my train of thought already. I lost the second one then. So you talked about, you got a couple of extremes. You've got the retiree that's got 400,000, 500,000 that they want to kind of, they want to supplement their income, or that is their income. They're
Mm.
using that. So realistically, especially if they're doing a first mortgage or a couple of first mortgages with that money, what kind of these days, what kind of interest rates are they getting on that?
Yeah, that's a great question. I don't want to get too specific in that, especially as a licensed individual. You don't want to do
Yeah.
that.
Well, the
But
range, let's say a
but I can
range.
tell you that by and large, a first mortgage can go for anywhere from 6% up to on average, maybe about 12, 13
Wow.
in some places, right? So
Yeah.
it is a large swing. Again, you're going to get less if you're in the city. You're going to get more if you come outside of the cities, and then it depends on some of the situations,
Right. How
what
much
you're going to
risk there
get.
is, what the
Yeah,
person's credit situation is, that sort of
yeah.
thing. So the question that might come to some people's mind is, well, why would anybody with decent credit and enough cash that they only need 50% loan to value on a mortgage, why would they go with a private lender at those kind of rates versus just with the bank?
Oh gosh, there's a whole host of reasons. The
Yeah. What are the
one
biggest
of
ones that you
the
see?
one of the one of the easiest ones is as an investor. You don't want to waste your time going to the banks and through the bank process. You go
As
in,
another
you borrow.
as an active real estate investor. Got it.
Yeah,
Okay. Yeah.
you go in, you buy it with cash using private mortgage, right? And off you go. If you're doing a flip, if you're doing some other type process. The for residential buyers, the reason that they'll do it a lot of times is maybe there's a where they're getting the source of income. Maybe the
Mm.
it's coming from a source over here that the bank won't approve.
What
So
so what would
again,
be
you
what would be an example of that just to give us an idea? Because the banks are so
let's say you
persnickety.
borrow money from a line of credit, an unsecured line of credit. Well, the bank won't let you do that,
Ah.
right? They want to now take that calculated as part of the mortgage.
Mm.
But if you now own the property, you buy it, use private money, do that, then you can go back to the bank and
Got it.
refinance it. You move out all of those rules. The other big one is there's often times when people have good jobs, but perhaps they lost a job or there was a divorce or something like that, and their credit was hurt.
Right.
And so they've
Bankruptcy,
got
something
money,
like that.
but the bank won't touch
Yeah.
them.
Yeah,
So
they're not 7 years out of a bankruptcy or something like that, right?
that's right.
Yeah.
And so now here you go. All of a sudden you jump in
Makes
and
sense. Yeah.
you do that, and then you get time to a lot of the deals, especially with debt consolidations. A lot of the deals are people that need to raise their credit score, and so you need to. They're buying time effectively.
Yeah. That makes a ton of sense. All right. The other question I had was we got the extremes. We got the retiree with 500,000 or
Yeah.
$1 million to do this business with. Then we got your kid that's just getting started with 3 grand. We understand what the people with the 500 grand are doing. What's somebody with three, five, $10,000 able to do in private lending?
Well, actually, I'll give you as since we're closing out, I'll give you a
Yeah.
fun little example because people wonder what can you do with it. So my wife wanted to buy the kids a car for because they're all getting their license and didn't want to give them our vehicles, right? So
Fair
I
enough.
wanted
Yeah.
to get. So here she is. She got 10 grand. She's going out to buy the vehicle, and I said, "I'm coming with you. I'm coming with you." She found a nice vehicle. It was 20 grand, and and she said, "Okay, I can put 10 grand down, and then I can." We can get the rest. And I said, no, we're not doing that. We're going to finance that vehicle at 8%. And we took the 10 grand and lent it out at a higher interest rate.
At 16%.
And then when the money comes in on a monthly basis, the checks come in on a monthly basis, take that, put that towards the car payment, and and then at the end of the that period, you've got the car and you've still got the money,
That sounds like a rich dad,
right?
poor dad idea there.
Eh,
That's
there it is, right up there on the shelf. That was the guy that
brilliant. So
got
you
me
did that.
started.
Yeah. That's really
Yeah,
smart. That's a smart way.
that was the one that
So
started me off. So
yeah, Kiyosaki talks about, taking what you do to buy a brand new vehicle and putting it as a down payment on a property. You did it a little differently. You put that in as a private loan and use the
Yep.
income from that to pay the car payment.
Yeah.
Smart. Yeah.
Yeah.
Really
Or you
smart.
can, I mean, you could do the same thing. Uh, you take that, lend it out, the money that comes back, use that for your vacation every year,
Yeah, exactly.
right?
Yeah.
$20,000, you're gonna, let's say you at 10%, that's 2 grand every year,
Mhm.
right? That you can put on your vacation every year. And you can go on vacation every year for free for the rest of your life.
Nice. Neil, if people want to find out more and connect with you, where do you suggest they go?
Oh, probably the best place to find me is on LinkedIn, Neil D'Souza, and you can't miss me. I'm wearing my nice black tux in there, so
Are
yeah,
you
come
rocking
at
the
me.
beard in your LinkedIn picture?
It's a much shorter beard at that point in time. This is my winter beard.
It's impressive, man.
Maybe even my cowboy beard. So
The Kingston Cowboy.
Kingston Cowboy, love it, love it.
There you go. Neil, thanks so much for being on the show. This has been a lot of fun.
Yes, thank you very much for having me, Dave.
All right, everybody, take care. We'll see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now, at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.